What if you could generate figures like this, and even this on a day-to-day basis without having to work more than 4 hours every single day? Well, that's exactly what I'm going to show you how you can do in this video, so just stay tuned. Today what I wanted to cover is exactly how Forex works from a basic point of view. Now what I mean by this is so many people ask the same question over and over again. And that question, simply put, is you show all these trades, you show your profit, you show doing X, Y, and Z, but you don't actually go ahead and explain how any of it works. Well, that's exactly what I want to give you in this video. Rather than just breaking down trades that have made a profit or a loss in the markets and showing you the actual strategy, I want to tell you what even is Forex, what is a currency pair, how does all of this work, and the real basics and bare bone basics of Forex trading. What actually is Forex as a concept and a meaning in itself? Well, Forex, also known as the foreign currency exchange market, is essentially an asset class within trading. So you may have heard of stocks, shares, and holding actual pieces of a company. Well, Forex works in a similar way but differently. Essentially, what you own is you own a currency pair. And with this currency pair, you're basically betting and placing a trade on the idea of the value either increasing or decreasing. Now, we can make money from both buying and selling these currencies. So if a market was to be uptrending and we were to buy that value, then we would make a profit. However, if we said, okay, we think this currency is going to decrease in value, we would sell that idea. And by having this idea selling process, we're able to benefit from an increase in the market when a currency is increasing in value. And we're also able to benefit and profit from a decrease in market value when a currency is losing its value. Now, a currency pair, as it's simply put, is made up of a pair. And this pair is two different currencies. And you put these together to make the currency pairing. Now, this currency pairing has a major currency, and the major currency is the first currency of that pairing. So let's take the pound against the dollar, for example. Our main or our major pair would be the pound that we're trading against the value of the dollar. So if we were to buy into the market, we're going to be buying the idea that the pound is going to increase in value against the dollar. And same again, if we were to go ahead and sell the pound's value because we think it's going to decrease, then we'd be selling the pound's value against the dollar. We only ever look at the first pair really in the actual currency pair that we're trading, because that is the one we're buying or selling the idea of. Of course, within trading, it's important to look at everything and look at the bigger picture. So you also want to account for the factor that you're trading against another pair. However, the pair that we're placing our idea on and saying whether we think it's going to increase or decrease in value will be that first currency in the pairing. When it comes to trading Forex, you never actually own anything physical. So let's say we were to go ahead and buy a share or a stock in Amazon, Tesla, whatever it might be, we would own a physical portion, whether it be micro or whether it be a large share of that company. We would essentially own a portion of everything that they're doing within their business. But Forex isn't actually a physical business. It's not selling goods to consumers and things in that way. However, it's how the entire world works. This is the foreign currency exchange markets. This is the movements of all of our currencies. So when those companies like Amazon, Apple, Tesla are going out there purchasing their goods and trading with other companies in different areas of the world, they essentially want the best value for their buck. Now, how they can do this is by using the foreign currency exchange logic. By having a currency that's in their favor at the time of them buying goods against maybe a weaker currency in another country, they're able to use their strong currency to buy a lot more goods in that weaker country's currency. Now, essentially by doing this, what we can do is we can do this online. So rather than owning a stock and a share in an actual company and then needing to make a benefit from whatever the company does, and if the company makes a profit, instead what we do is we look at the currency valuations and compare them. There's several things that are going to go ahead and move or create volume and volatility within a currency pairing. Some of those could be things like news events, war, or any other sort of large economical event, speech, or something drastic happening within the world that is unexpected but has a mass impact on individuals or on the economy. But how can we actually go ahead and identify these movements in the markets and the value of these currency pairs to go ahead and either buy or sell the theory that they're going to increase or decrease in value? Well, we do this through utilizing a charting platform and viewing what's known as candlesticks. No, not a candlestick and wick like this. Instead, something like this. And essentially what we can do with these candlesticks is we can allow them to print different price action movements in the markets that we can then take the idea of and trade based on probability. Every second that someone buys or sells within the market, these candlesticks are going to have a movement. And we can watch these candlestick movements on what's known as different time frames. Now, time frames are essentially how we're viewing these price action movements. So let's say we look at the chart in 5-minute increments. After we've seen 12 of these 5-minute candlesticks printing onto our charts, what we're going to have is we're going to have a 1-hour time frame candlestick. Just one, but that's because each of those 5 minutes multiplied by 12 is going to make that 1-hour candle. But what we can do is, instead of just looking at 1 hour's worth of price action, or 1 day, 1 week, 1 month, or even a year plus, we can look at the smaller time frames. And by doing this, we can make money in those smaller increments and those smaller movements within the markets. So by taking the idea of, say, a 1 hour or a 4-hour candlestick and applying that to something like the 2 or the 5-minute time frame, we're going to be able to gain an edge and find trades on a more frequent basis. Now, the personal trading that I do is intraday trading. This is where we're in and out within several hours. Hence, I mentioned at the start, you can work for less than 4 hours a day and still extract a profit from the markets. Now, just looping back to candlesticks, when these candlesticks are forming and moving in the markets, they move in what is known as trends. You can have 3 types of trends. You can have an uptrend or a bullish trend. You can have a downtrend or a bearish trend, as it is known. Now, an easy way that I've always remembered this is a bull is going to push up with its horns, and a bear is going to push down with its weight and pressure into the ground with its paws. And that's essentially how you can view it. That always the bull is going to push things up and the bear is always going to be bringing things back down and pushing things back down. However, when we're looking at these candlestick movements, we use multiple of them in a batch in order to form that up movement or that down movement within the markets. So by combining, like I said, 12 of those 5-minute candlesticks, we're able to see a formation in the charts in either or direction. Now, I obviously mentioned that there's 3 types of trends when it comes to Forex. The third type of trend is a consolidation market or a sideways range. And this is essentially where the market doesn't have a clear direction, it's not breaking to a higher point in the market, or it's not breaking to a lower point in the market. It's simply staying between an equal level and just moving sideways. This would be the least optimal time that we'd want to be trading and involved in the markets. The reason being is because there's no clear trend and clear direction to make a profit from. Remember, we always profit from the movements in the market. So if the movement is having a massive impulse increase and we have purchased at the lows of that, we're going to make a profit when it reaches the high. If the market's at a high and we've sold the idea at that high point, when that market decreases, we're going to make a profit on that decrease. However, if you purchase at a midpoint here, it goes up, down, up, down, up, down, you're not making any money. You're just stuck in a market that's sideways ranging or consolidating that is unprofitable. So what we look for is we look for a simple formula in the market that I can teach you on this very YouTube channel in order to plot our trades following a simple mechanism within the markets that gets repeated on a weekly and monthly basis across decades of historical trading data. But anyway, less of that because that's only going to confuse you when we're covering the basics. What I want to tell you is the market moves in trends. We can profit from these trends by purchasing or selling the idea that a currency pair is going to increase or decrease in value. And in order to view this, we view it through candlesticks. So that's what we've covered up to this point. We know what Forex means, we know what a currency pair is, and we know that the currency pair moves in the form of candlesticks and trends. So you want to start looking at building the skill of trading. Obviously, next is going to be actually formulating a strategy that you can go ahead and use in the markets. A strategy in the markets is when you're putting essentially confluences together in order to come up with a strong idea. If you're going into a shop on Black Friday, you're never going to be looking for the worst discount and the worst priced item that you can go ahead and buy for as close to its retail value as possible. So you're not going to want to go ahead and do that in the markets. So what we essentially wait for is we wait for these black market discounts on a day-to-day basis within the market, also known as the golden zone or a Fibonacci mathematical zone that we can enter from within the market. Personally, that's what I use to find these discount zones so I can go ahead and find an entry. Now, that's only one confluence that I use, and a confluence within trading is essentially a confirmation that we're marking off in order to say my trade criteria has been met, therefore this is a valid trade I'm willing to go ahead and enter into. If my checklist doesn't get met, seeing as I trade a nice mechanical and simple model in the markets, I'd take a step back and I wouldn't trade that model for the day. I'd then be looking at the next trade idea. Now we're always using mathematical zones in order to make a profit. Now don't get too caught up and confused on all of this. What I'm trying to say is a strategy is just putting confluences together in order to form a checklist that you can then follow on a day-to-day basis in the markets in order to gain an edge and extract a profit. Now you can go ahead and build your own strategy and spend hours and hours deciphering through different confluence videos and working out what you can piece together yourself. Or you could go ahead and implement a proven and working strategy like the Samurai, which is a nice and simple SMC based strategy that I trade on a day-to-day basis. It works across so many pairs and it follows a very simple formula. You can literally get onto the charts in the morning, observe what you're observing for sort of 20 to 25 minutes. If nothing presents itself during that time, you take a step back and you come back later. That is how simple you can make trading. Too many people nowadays are overcomplicating and making every single movement very discretionary and very emotional. If you just actually take a step back and you look at the broader picture, these markets have moved in a pattern over a history of time. You can use zones and maths and probabilities in order to gain an edge in the markets where you can then take a profit without having to beat a $6 trillion industry every single day. So you've gone ahead and found the route that you want to follow with your strategy. And by the way, if you do want to learn how the Samurai works, check the link in the description for my free Discord community. We break down live trades, we give analysis, and we have a free call every single week for members. So get yourself involved in that community. It would be good to see you all there. Once you've got your strategy, you're now looking to go ahead and take that into the markets. So you're viewing charts on an analysis platform, you're seeing candlesticks, you're seeing trends, and you understand concepts and strategies. But you need to actually find a way to make a profit from the market, right? Well, you've never even experienced the market itself and how profits and losses work. So what can you go ahead and do? Well, funding option number one is using a paper trading or simulated capital account. This is essentially just a skill builder. This allows you to master one particular craft and work on one particular skill without ever actually having to go ahead and invest real money into the markets. So what you can do is you can literally set up a demo trading account. This is paper, fake money, and you can then trade in the live real markets with updated live market data. So you're essentially simulating your strategy, your psychology, and everything else that you're going to learn about trading without ever risking a dime. Now, by doing this, you allow yourself to build up sort of a paper trading track record. So it says, I can do what I claim to do, and I'm successful at what I want to do as well. Once you've got that, you can go ahead and look at the other two funding options. Option number two is going to be through prop firm capital. Now, prop firms are essentially a large investment firm that's going to lend you capital to follow their rules, and if you follow their rules, they're going to give you a payout reward in exchange for that. So let's say you went ahead and earned $10,000 on an account, they'd give you maybe up to 80 or 90% of that $10,000 that you've earned successfully by trading within their rules. Now, how this works is it allows you to access much larger amounts of capital without needing to have it just to inject into your trading account yourself. You can access 5, 6, or even 7 figures worth of capital off of these prop firms to go ahead and trade on. It works in a very simple way. You take an amount of capital that you would maybe invest into a live account, which I'm going to mention in a moment, and then you would go and put that into a challenge. You follow the criteria of the prop firm that they have set out for you, and as long as you follow that criteria successfully, you can go ahead and get yourself that profit split reward that I mentioned. Obviously, by you trading on a much larger amount of capital, you're able to make the same amount of percentages without ever over risking, but make a larger amount of profit. So take a £1,000 trade, for example. If you make £1,000 on one trade off of a 10k balance, then you've gone ahead and made 10%. If you were to make that same 10% on 100,000, you'd be making the 10k as your profit. So that just kind of shows you sort of the power behind prop firm capital and why a lot of people choose to go down that route when they're getting into trading. Now, method number 3 that I wanted to talk about was actually setting up a live brokerage account. So what is a live brokerage account? Well, first of all, what is a broker? Now, a broker is used in all of the examples I mentioned for the route of funding. A broker essentially is a middleman in the markets. This is going to connect those buyers and those sellers together, and those sellers and those buyers together. What this means is that a middleman or a broker comes into the market when I want to buy something. They then find somebody that's willing to sell it to me at the price I'd like to buy it at. The broker then puts us together, they're able to sell their asset and I'm able to buy my asset. By doing that, they filled 2 orders in the market. Every route of funding within the market requires a broker because a broker is providing you a live feed of the values of those currency pairs that we mentioned. Without a broker, we can't view anything. We can't view an analysis platform and see the values of these currencies because we don't have it coming from a brokerage firm. So we always use a broker. However, some brokers allow us to set up a live account. Now, a live account, up to your own discretion, is where you can put funds into an account and then trade that fund actively without it being anybody else's capital, without you purchasing a challenge, and without it being simulated. This is if you were to go into a shop and buy an item with your funds, you would set up a brokerage account, invest your own funds into that, and that would be the item in exchange. You'd be able to trade that for a profit or a loss in the markets. So by using a brokerage firm and setting up a live account, yes, you'll be operating potentially with smaller amounts of capital. However, the money is always yours. There's no criteria, there's no rulings, and therefore you can take the money out within 48 hours on most of these brokerage firms. But anyway, all 3 of these routes utilize a broker, and it's important to understand what a broker is within trading, and it's also important to understand that each of these methods has its own pros and cons. So what I'd recommend to you is probably do your own research into each of them individually, and if you're interested in that, go ahead and comment and I'll make a video on each of these methods as well, so you can see my personal pros and cons of each of these funding methods within Forex trading. I just want to mention how a broker makes a profit in the market. So you might be thinking, okay, they're going to provide me the value of the currencies, they're going to connect me with the seller or the buyer that wants to buy or sell the currency at the value I'm willing to do the opposite of, but how are they actually making money off of me? Do I pay them each month to be a member of their platform, or how does that work? So brokers make money in various different ways. Now, 3 of those ways I'm going to mention in this video. The first way that a broker can actually go ahead and earn money from the trades in which you're entering in the market is through what's known as a spread. Now, a spread is the difference between the sell and the buy price of a currency, or ask and bid. Now, essentially what this means is the difference between this buy and sell price is where they make their money. So let's say it was $1 for a sell price to $1.50 to buy it. That 50 cent in the middle is going to be where you're able to make up the difference as a broker. So the broker goes ahead and extracts that from entering the trade, and therefore you enter the trade in a slight amount of drawdown. That drawdown is going to be whatever the difference is between the buy and the sell price of that currency. So if you did go ahead and open option 1 of the funding options that I mentioned, which is a simulated or paper trading account as it's better known as, then you would see naturally as soon as you open any position size, it will go into a drawdown. And this is due to the fact that there is a spread on that trade. And that spread is how the broker is earning their money. That drawdown is taken by the broker, and then by you making a larger profit on that trade, you outweigh the cost of that spread, therefore making a profit for yourself, while the broker still remains in profit themselves. Method number 2 that a broker can go ahead and use to earn money is through a fee. Now, a fee is actually just a fixed dollar or whatever currency amount taken per every trade that you're entering into the market. So sometimes this can be more beneficial or less beneficial depending on the type of trading that you're doing within the markets. Now, method number 3 that they can go ahead and make a profit from yourself when you're entering into trades in the market is from a commission. Now, this varies based on the size or the volume of the trade that you're entering into within the financial markets. The bigger the trade that you enter into, obviously the larger that their commission is going to be when taken out of the trade that you've entered. So just bear that in mind when you're using a high commission broker, that potentially entering larger positions could result in a larger amount being taken per each trade. But again, as mentioned, there's pros and cons to each of these methods, the same as when it comes to choosing the method of funding that you'd want to go with. So make sure you do research into each of these and decide what best fits your day-to-day and your type of strategy. Moving on to my next point, and probably 80% of what trading actually means, is psychology and mindset. Now, you've probably heard every other YouTuber and trading guru mention mindset and psychology and how it's such an important factor. but it really is. Like, once you learn a simple strategy, even if it's something like the Samurai, where it's a nice and easy mechanical based model that you're following a checklist day to day, and if this doesn't happen, then you don't do this, or if this happens, then you do this, it's going to come down to you as an individual. At the end of the day, if you want to enter more trades in the market, it's you that's placing that buy or sell button. If you want to go ahead and over risk on that one trade you're taking every single day, it's you that's going to determine what risk you enter into that position. So it's all down to you as an individual. If you have no self-control, you have no self-discipline, and you have no consistency to stick through those drawdown periods and also just accept the wins for what they are and move on as if it was nothing, then you're not going to be able to put yourself in the position of being a successful and profitable trader. So what I mean by this is you really need to wake up to yourself and have some solid self-awareness when it comes to getting involved in trading. There's no point just tending to the markets and saying, right, I've got a strategy, I'm just going to do this every single day and it's just going to work out for me. Because what happens when you have 2-3 losses that you've never had before, because you've always worked, say, a paycheck job where it's only ever making money on a monthly basis until you have expenses? Well, trading completely changes that psychologically, because now instead, when you're making a profit and you're earning your income, you're actually facing losses along the way. So it's getting your head around that whole idea and concept when it comes to trading before just tending to the markets, gambling your way through it, burning everything, and being back in a depression and square one where you really don't want to give it your best shot. So instead, save yourself all of those troubles and dial into your mindset and your focus. If you're interested in learning about psychology and mindset and what you need to kind of think of yourself when it comes to trading, then I'm making a really good unlimited program at the moment that is never going to end, called Foundation to Freedom. This is on YouTube for completely free, by the way, so I'm not promoting anything to you. You can literally find the other videos somewhere located around this or in the description below. But this is a free online course that I'm going through trading, I'm going through everything strategy wise, but I'm also diving into mindset, psychology, understanding yourself, having that self-awareness in order to take the skill of trading and become a successful trader. So we've covered all of what you kind of need as the basics. You know now what Forex actually means as a concept. You know that Forex operates with currency pairs that move via candlestick movements in upwards, downwards, or consolidating trends, ranging markets, also known as. And you also know the whole point that psychology and different funding options are important to research into before just throwing yourself deep into trading. So once you've got all of this, as I mentioned earlier, it's about having that profitable strategy and having something super simple that you can implement into the markets to then focus on what does really matter, which is risk management, psychology, mindset, and growing your portfolio and diversifying successfully. So how can you go ahead and learn a simple mechanical SMC based strategy? Well, you can do that through A, the free Discord that's going to be linked down in the description below, or B, going onto my channel, dropping me a subscribe, turning on post notifications, and staying tuned for all of the upcoming releases that I've got, breaking down my strategy and daily live trade examples. So if you're interested in all of that, then stick around. But anyway, that's been it for this video. I appreciate you sticking around, and I hope you've gained some basic understanding of what Forex is and how you can go ahead and start looking into the subject for yourself.